Welcome, my friend, to this technical analysis tutorial with the very controversial title of Indicators Are Never Wrong. Okay, that is a strong statement. In technical analysis, indicators are never wrong because, let's just be very literal about what indicators are. They are mathematical formulas. So they're not magical, but they are mathematical. What happens when we talk about this in most traders' minds? Well, they start to think of people who say, well, I don't trade with any indicators. I don't need any stinking indicators. They are all lagging, things like that. And let's deep dive into that a little bit. All right, there's a lot of truth to that, but it isn't the truth, the whole truth, and nothing but the truth. So when we talk about indicators being lagging, it is an issue of, yes, I acknowledge what people are saying by that in the sense that the market, okay, in this case, whatever market, we're looking at the stock market today here, but just using an example, no particular reason that I'm looking at the stock market, but whether it's futures, Forex, whatever, you've got people who say, well, I just look at price bars. Well, think of price bars. Are they leading? No. That price bar there is also lagging. And so is every other price bar on the chart in the sense of it's already posted data. The data is done. The buying, the selling is done when that bar is closed. And therefore, after that bar is closed, well, now that data is done. It's not telling you anything about the future necessarily. Now, some people might disagree with that, with price patterns and so forth. And perhaps we'll get into that in a future video, because then you get into the whole issue of, well, are price patterns leading? And there's been a lot of studies done on that. But today we want to just focus on the issue that a price bar is just as lagging as an indicator is, in the sense of, here we have MFI, as you can see, but any indicator. It's just taking the data from whatever market you're trading relative to whatever time interval you're trading. It's taking that data, putting into the left side of a math equation, and then that indicator's equation crunches the numbers and spits out a value out the right side. So over here, that's the value at this snapshot on time. So really, the indicator isn't leading or lagging price. It's giving you the it's giving you the information at the exact same time, which is in real time. So that is the first thing to say. Now, why do I say indicators are never wrong? Because math is never wrong. Math is just it. It is always what it is. So you can't really say that indicators are wrong. I find that people get sloppy about their language because they imply things from that language, and then they use that language in their self-talk, and it messes them up psychologically when they come to trading, because they're not being accurate enough in their understandings and their definitions of things. Therefore, what we need to be looking at here is the fact that indicators by themselves, price bars by themselves, nothing by itself makes us money. So normally when people say, well, indicators are wrong or whatever, they're talking in the context of making money, right? So that's going beyond the next step of what I'm talking about here, which is just being very literal. Now, to make money in the market, we cannot rely on any one thing. There's no certainties in the market. There's no one magic holy grail indicator. There's no one magic holy grail candlestick pattern or multi-bar pattern or moving average or anything like that. The way that I make money in the market is by putting together 5 non-correlated variables. And when they all agree, they're all bullish or bearish, because they're non-correlated, it gives me a probability scenario. Still does not give me a certainty. There is no certainty in trading. In fact, I don't even like calling trading trading. I'm a little old-fashioned, born in 1959, so back in the days of yore, we didn't have computers. Heck, we had a black and white TV. So I'm an oldster. And back then, back in the days of Jesse Livermore, thinking about that, if you've ever read the classic books about him and so forth, they called it speculation back in those days. I actually like that term better because that's really what we're doing. And again, the self-talk. If I call it speculation, then it reminds me, keeps in the forefront of my mind, that what I'm doing is risky. And that what we're doing is managing risk. And there are no certainties. So I prefer that term still. Call me old-fashioned, fine, but I think it helps me psychologically. Actually, I know it helps me psychologically. That's up to you whether you want to adopt that term, that ancient term, or not. Okay, so getting back to how can these things be helpful in actually making money. So since there's no one thing, what I look for are 5 energies in the market, and I'm looking for them at the moment of taking the trade. Those 5 energies are number 1, and I trade them, or I look at them in this order. Number 1 is the trend, the direction of the market. Not only the direction, but am I early in a new trend? That's a good place to start. Tells you, okay, which side of the market do you want to be on? Also, the trend is your friend until the end, so we don't want to trade a trend late. We want to trade it early. So timing in the trend is critical. Number 2 is momentum. That determines what the strength of that trend is. Is it a strong trend or a weak trend? That's going to determine whether I want to trade in the direction of the trend or not, because there are weak trends. And a weak trend, even if you trade in the direction of it, you will get stopped out. Number 3 is cycles, and that's about timing your entry, when to get in, when to get out, when are you going to get a final swing high or final swing low, so that after you get in, you don't get stopped out. By the way, I do have an amazing timing indicator that I actually give away for free on a webinar that I offer, absolutely free. Feel free to send me an email, barry@topdogtrading.com, to get access to that. And it works on any charting platform, any market, and that's a freebie that I give out. And I give you a free tutorial with it as well. Those are the first 3 energies. Energy number 4, support resistance levels. And number 5 is then the fractal energy, where I'm looking for the dominant energy of the next higher time frame. And that's it. Those 5 non-correlated energies. When they're all bullish, I go long. When they're all bearish, I go short. I put in hard stops. I hedge my position to manage the risk. And that's trading in a nutshell. So let's look at a couple of things here real quick, and I'll show you why they work sometimes, why they give us a high probability scenario. So first of all, let's get this stuff off here and drawing a couple of new lines. So first of all, for a trend, as you can see here, I use the 50-period simple moving average. Why? Is there any magic to it? Nope. But on a daily chart, a lot of people look at it. So one of the reasons that certain things in technical analysis work is because they have a self-fulfilling prophecy to them. Nothing magical. It's just purely that you got a lot of people looking at it. And anytime you have a lot of people looking at something, then the mass psychology kicks in and people respond to it. So especially on a daily chart, lots and lots and lots of people look at a 50-period simple moving average. You see it provides resistance here, provided resistance over here. Again, nothing magical. It's just mass psychology. So the same principle applies with support resistance. Nothing magical about them. But if you have certain levels that everybody's looking at, 52-week highs and lows would be a good example of that, then the market's going to respond to it in some way. And you should include it as part of your trading methodology. Keep your eye on it, knowing that everybody's watching that level. Okay? Again, can't trade it alone. It's one piece of evidence. Now, so that's one category of technical analysis indicators, which, again, is things that a lot of people are looking at. And that's the reason that they work, or at least give you a probability scenario as part of an overall method. The other thing that we'll talk about today is momentum. So momentum is the second thing that I look at after trend. Here we have the MFI. And whoops, okay, that's messed up. I thought I was using my arrow there. But so MFI, there we go, money flow indicator. Or money flow index, actually, it's called. And it is a volume-weighted RSI. So it's similar to the RSI, but it incorporates volume, which is what makes it actually a more literal momentum indicator. You don't have RSI is not a momentum indicator. That's the big scandal. Might as well throw another heresy out there. Technically, it is classically called a momentum indicator, but really it's a rate of change indicator because it doesn't incorporate weight. And in physics, momentum is volume times mass. So mass equates to volume in the market. And so if your indicator doesn't incorporate volume, it technically is not a literal momentum indicator. So anyway, let's talk about something practical here in trading. Those are, again, I'm a pretty literal guy, so that's why I bring those things up. So if you're going to trade something like, you're looking, we're in a downtrend here, right? And then we're going to look for connecting these two lows and trade a breakout. Great, fails, goes back up. What would give us an indication that that might fail, that that breakout might fail? Just a very simple example here is the momentum is up. So therefore, this is a weak trend. Momentum is moving up. Therefore, I would not want to sell bearish into bullish momentum. And therefore, again, the trend is your friend until the end. We've already been in this trend for a little while. And when you get a momentum shift, now it's like, okay, yeah, we're going down here a little bit. We break that little trend line. That's a common trading method that a lot of people use. Not a bad method, but I wouldn't trade the price pattern alone. I want to know, is the market moving down on strength or weakness? Here, it's moving down on weakness. We have conflicting energies, in other words. So I'm looking for the confluence of those five energies. We don't have it. We have the energies fighting each other here. Trend is down, momentum is up. So let me show you a different example of the opposite of that. So here we now have, if we were to draw our line across these highs and use that same technique, then we would again look at momentum, in this case, the MFI, and it is moving up. So therefore, as we break this trend line, we have upward momentum. 50 MA is up. It's early, again, early in a new trend being defined by getting above the 50 MA, the 50 MA angling up. So we're early in a new trend, not late in an old trend. So now the trend is our friend, but that's just direction. We need strength behind it. And in this case, momentum does confirm it. So we have an alignment, and therefore, when it breaks the trend line, it actually follows through. And that's the type of way that we combine indicators which mathematically measure the energies, these various energies of the market, the underlying energy of the auction place, if you will, to give us a probability scenario. And obviously, we always manage our risk in the process, but by having these non-correlated energies align, it gives us a much higher probability of success. And because the indicators are mathematical, and therefore they're never literally wrong, we can use them to create a rule-based method. We're actually measuring the flow of money, by the way, bar by bar. So I'm not necessarily looking for anything to be a long-term leading indicator. Again, I don't believe anything like that does exist. Nothing magical here. But we look for this kind of stuff at the moment we enter. So at that moment, that's what I'm interested in. So in fact, if you look, we've even got a trend line break here, right? So it's at the moment I enter that I'm interested in all this stuff. And that's the only moment. And then from there, I trade bar by bar, and I continue to watch the money flow, the energy of the market. Because the market can do anything at any time. It can change at any time. And this is why nobody can predict the long-term moves of the market. So we use our trailing stops and our targets and things like that to help us to become successful traders. Now, if you like this video, please understand the universe says it's not free. That's right, because according to the universe, karma, and universal spiritual principles, if you got value from this, you have a moral obligation to pay it forward by clicking on the share button below. And you know what? You get a warm feeling in your heart, and you know you did the right thing by sharing something good with other people. And that's really the best thing that you can do. Now, if you're watching this on YouTube, also click the thumbs up icon and hey, leave a comment. I love your comments. In fact, they encourage me to continue to create more free lessons for you. Super special thing I've got for you is one of my favorite trade strategies that I will give you absolutely free with all the rules and the parameters and the filters. It's called the rubber band trade. It has a very high win-loss ratio. It's actually a simple trade. I can teach it to you in 26 short minutes. Get my rubber band trade strategy absolutely free by clicking on the image in the top right corner of this video or in the description below the video. And if you're not watching on YouTube, then there's probably a link below or an opt-in form on the side. Once you do that, I'll personally email the video to you with the rubber band trade strategy.